Good morning, everybody. It's Monday, August 4th, 2025. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. As a reminder, you can follow me intra-week on LinkedIn. If I've got anything to say, it'll be under Herb Morgan, or on X at Herb W. Morgan. Presentation you're seeing and or hearing is designed by me. It is designed to be used by you. Doesn't matter if you are an investor or a financial advisor, you're still expected to make your own investment decisions. Nothing contained in the presentation should be treated as advice. There's no recommendation for the purchase or sale of any securities. It's all for informational purposes only. The views are mine and mine alone. They may differ from the views of CFIA's parent affiliates or other portfolio managers here at the firm. Well, it was a bloody week in the equity markets. You can see S&P 500 down about 2%, mid and small cap stocks getting down at 3.5% and almost 4% respectively. International markets down 3%. That's developed. Emerging international markets down about 2.5%. Bringing the year-to-date numbers back into some sort of reality, at least for the domestic indices. Fixed income markets caught a bid. Look at long-dated treasuries up 2% on the week. All those folks holding on to those long U.S. Treasury ETFs or long-dated bonds, wondering when they were going to go back up. Well, it's when times get rough. That's why you have a balanced portfolio. When the market gets sold off, the money flows into U.S. Treasury securities. It drives those prices up. The longer the maturity, the more elastic it is to that movement. So if the market was rallying, they would probably go down more. When the market's tanking, they go up more. That's why you have both in a portfolio. Let's start with economic data. We had a lot of economic data last week. We need to cover the Fed meeting, the FOMC meeting. Earnings are still going on. They're very, very good, by the way, but let's start with residential real estate. FHFA House Price Index down 0.2% on the month. We're hearing a lot of stories about real estate prices getting marked down, home prices dropping, lots of unsold homes. I'm hearing it anecdotally, and we're seeing it in some of the data. The year-over-year gain in home prices is now more modest, more normal, 2.8%. Not those big gains we saw. We had those artificially low interest rates. Same kind of thing from Case-Shiller. They say it was down 0.34%, also looking at about 2.8% on a year-over-year basis. Consumer confidence and University of Michigan consumer confidence, so Conference Board and Michigan consumer confidence numbers. Let's start with the Conference Board. They say went from 95.2 to 97.2, so it's a little bit of a pickup there. Still well below where we were sort of, let's say, prior to 2020 and prior to the onset of the COVID-19 pandemic. We followed it up with University of Michigan sentiment, same kind of pattern, much lower than we were pre-pandemic, and really not that great, but up. Okay, it rose from 60.7 to 61.7. Current conditions rose a little bit. Expectations fell a little bit. Both personal income and spending for the month of June rose by an identical amount, 0.3%, and they're up on a year-over-year basis by an identical amount, both up 4.7% year over year. We follow that up with PCE, personal consumption expenditures, the price index, and the core of the same. This is the measurement the Fed uses to determine whether or not they're meeting their mandate of price stability. Price stability, they define it, self-defined, as 2% core PCE inflation. Core PCE inflation is not at 2%, it's at 2.8. That is the reason 7 of the 9 Fed governors voted to not cut interest rates. There's this relationship. They believe by keeping the interest rates higher, that stifles the pace of the growth, which could impede the inflation. That's a good thing. We want to impede the inflation. We also got GDP for the second quarter. It came in at a very high rate, annualized at 3%, but that reverses the minus 0.5% annualized rate from the first quarter. What happened? In the first quarter, there was a surge in imports, which are a subtraction of GDP. They wanted to get the imports in ahead of the tariffs. They did that, but that means there's less imports to have in the second quarter. Therefore, that is more positive for GDP. The bottom line is the overall economy did not grow at a 3% annualized pace in the second quarter. The political spin from both sides was interesting last week. I looked through it. Let's look at personal consumption. That tells you that the overall economy grew at an annualized pace of about 1.5%. after inflation, so real growth of 1.5. That's a real increase in our standard of living. It was a good quarter, just wasn't a 3% real growth quarter. Okay. Then we move on to JOLTS. June job openings fell from 7.71 to 7.437. Total unemployed in the economy at 7.236 million. Pretty close to equilibrium now in the jobs market in terms of it moving the price of labor up or down. Labor has been sort of in the strong or the strength position here for several years coming out of COVID. We've seen nice gains in real wages, and now we're getting closer to a little bit more of a balance. Moving on, speaking of labor, let's talk about it. Initial claims for unemployment, the regular Thursday report, still great. You're just not getting big layoffs. 218,000 versus 217 the prior week. Continuing claims for unemployment still well below 2 million. This suggests a very healthy jobs market. But we're going to get to what happened on Friday here in just a minute because it kind of was a big deal. We're going to start with the earlier in the week report from ADP. ADP employment report says that we added 104,000 jobs in the month of July. Okay, no problem. But the estimate was for 76. So we're all looking at this going, hey, it was a beat, it was a great, everybody's feeling good. If you remember last month, ADP was a terrible number, followed up by a great number from BLS, and then so they just forgot about it. Well, this month ADP was good, followed that up by BLS, which wasn't good. You said, what do you mean? What do you mean it wasn't good? We had 73,000 over here. Well, the estimate was for 104, so it was below expectations. But the big thing was that the June number that previously had been reported as really good, at 147, they revised it. Said, no, we got it wrong. It was actually 14. This was such a big deal that the president got involved over the weekend, threatening to fire the person inside the Bureau of Labor Statistics that's in charge of putting out this report. And if you include the two downward revisions, we're now looking at a total delta difference in jobs created of about 258,000, and the unemployment rate kicked up. Now, 4.2 is still considered full employment. Looking at the weekly claims, looking at EP, this was still a positive. The jobs market's fine. But what it did do is it caused people to reassess how strong the market is. And on a day-to-day, like we had on Friday, there's people that trade the market on leverage, high rates of speed, using very fast computers with large amounts of leverage. They sent the market selling off on Friday. For those of us that are long-term investors, we're fine. Remember a week ago, I was telling you all these great things in the future, whether it's AI or capital investment or pro-growth tax policy. All of these things are still very true. We just had a revision to a couple of months' jobs. But what that did was that then brought into the fold, oh, maybe we are going to cut interest rates in September. So we'll get back to that in just a second when I talk about the FOMC meeting. First, we got the manufacturing PMI from S&P Global, dipped below 50. It was 49.8. So we're going to call that flat, call it 50, close enough. But then we got the ISM number, which for the better part of 3 years now has been below 50. We talked a couple of weeks ago about the difference in how these two reports are measured. That hasn't really changed. We're not going to go through it again here. Needless to say, manufacturing is 15% of the economy. Not the greatest report. We move on this week. Later this week, we will be getting the services readings, okay? And that's 85% of the economy. They are both expected to be well over 50. Construction spending continues to be a drag, fell 0.4% in the month of June, down about 3% on a year-over-year basis. In fact, construction spending has declined in 8 of the last 10 months. So the big news of the week, other than that sort of soft and the revisions to the labor report that was on Friday, was the results of the Fed meeting, the July 29th and 30th FOMC meeting. The president, a lot of people really, certainly the real estate, the construction industry and residential real estate, they want to see those short-term rates cuts. Fed held the federal funds rate steady at 4.25 to 4.5, fifth consecutive meeting of doing this. What was unique this meeting was that 2 of the governors dissented. They said, hey, we see some weakness in the labor market brewing. We want to get ahead of that. We want to cut rates now. The other 7 members said, no, we want to see more evidence of a slowdown, and we're still very concerned about inflation. The Fed reaffirmed that it's very data dependent, and when the data comes out, they could change their stance. The data did then come out 2 days later on Friday, and the odds, this is the last bullet here. So before the meeting, the odds of a Fed rate cut in September by the futures markets were 65%. After the meeting, they cut all the way to 46%, and everybody said the rate cuts are now out to October. But after the bad jobs report, not bad, soft jobs report, they rallied back to 90%. So we're sitting, as I'm looking at my screen, about a 91% chance of a rate cut in September. Remember, the Fed doesn't meet in August. That's their big Jackson Hole uh, extravaganza out there with central bankers from all over the world coming to the US for this meeting. In the earnings season, we've had about 328 companies report, 270 have beat. The average surprise, the beat there is about 8%. That's pretty sizable, and everything's going fine. We're not concerned about much at all right now. Factory orders for the month of June expected today, minus 4.8. June trade deficit on Tuesday. The two services readings, as I mentioned, both expected to be over 50. Thursday, regular weekly claims, productivity, labor costs, and consumer credit all coming on Thursday. Thanks for tuning in, everybody. Remember, this is an audio podcast, but it's also a video podcast if you watch it on my YouTube channel, which is called Slaying Bulls and Bears. I make the complex and complicated simple and sensical. Thanks, everybody. Be back to you again next week.